Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
The US Securities and Exchange Commission fined Kim Kardashian $1.3 million last month. The reason? She was promoting cryptos on Instagram without disclosing that she was paid for it. Australia has a 5-year jail term for financial influencers or Finfluencers who operate without a license. But in India, where the number of Finfluencers and their followers are rapidly rising, their promotional activities seem to fall in a grey area. So far, the country's financial regulators haven't carved out any specific norms for Finfluencers. Our next report does a deep dive.
There is a lot more happening on social media platforms these days than the sharing of messages, family photos, and videos. It has grown beyond being a platform for light-hearted conversations. Users are increasingly relying on it for news, lifestyle hacks, and particularly financial advice, the trickiest of them. Latching onto the demand, influencer marketing has boomed with followers running into millions. The staggering rise in markets after the pandemic has also led to the rise of this new phenomenon. The influencers, especially in finance, have a tremendous impact on an individual's investment decisions. The main content of financial influencers includes educational videos on economy and markets, stock advice, and other personal finance-related advice. A financial influencer or finfluencer may not be qualified enough or a registered investment advisor to be giving advice to the public, but millions of followers still buy into the content because of the simplicity. These influencers break down head-scratching financial jargon in simple terms and explain it to the layman. Registered investment advisors are authorized by the markets regulator SEBI to advise clients on financial matters. India has about 1,300 registered investment advisors. Financial influencers, although offer financial literacy to a certain extent, pose risks to individuals' financial stability. It may be through paid partnerships, advertising, conflict of interest, etc. Brands often rope in influencers to advertise their products or services. These include mutual fund investments or crypto platforms or even IPOs, where influencers review the prospectus to attract retail attention. Many first-time investors who enter the markets with the idea of making money on a whim may be vulnerable to such content from financial influencers. That is not the case with the registered investment advisors, as they are required to disclose any conflicts of interest with the regulator. The rise of influencers has created a regulatory dilemma for the Securities and Exchange Board of India, with a growing investor base in the country. As of September quarter this fiscal, India has about 102.6 million demat accounts. About 41 million unique investors invest in mutual funds as of March this year. Currently, there are no regulations from SEBI that apply to financial influencers. However, the Advertising Standards Council of India, a voluntary self-regulatory organization, prescribes that upfront and prominent disclosures must be made by influencers on brand collaborations, advertisements, paid partnership, or sponsorship for all such posts on all platforms. It also directs influencers to follow due diligence. The ASCII guidelines are not legally binding on influencers. There has been some decline in violations by financial influencers, specifically with regards to promotional content on crypto assets. In FY22, there were a total of 415 instances of violations by influencers and celebrities in finance and cryptocurrency related content. Of this, 43 were finance related, while 372 were connected to cryptocurrency promotional content. In the first half of the current financial year, ASCII has observed a total of 71 violations in such cases, 15 being finance related, while 56 were on cryptocurrencies. The rampant nature of investment advice flooding social media has caught regulators' attention worldwide, whose hands are otherwise full already. In an increasingly digital age, according to a survey by a digital marketing institute, 70% of teens trust influencers more than traditional celebrities, and 86% of women use social media for purchasing advice. According to a Business Standard report, SEBI is considering ways through which such influencers can be brought under the regulatory net. According to an official, the regulator is trying to find a solution whereby at least those who are cashing out by giving advice on social media are brought under the regulatory ambit. Earlier this year, SEBI cracked down on celebrity advertising for cryptos. SEBI said that no prominent public figures, including celebrities, sportsmen, should endorse crypto products, and the advertising disclosure should also talk about possible violation of laws. However, it is tricky to clamp down on thousands of financial creators who churn out content on a regular basis, although other countries have brought out some form of regulation. In Australia, Finfluencers could face up to 5 years in jail if they provide financial advice without a license. Similarly, the European Securities and Markets Authority issued a public statement on investment recommendations made on social media, clarifying the definition of investment recommendations, how to post them properly on social media, and laying out the consequences of breaching the EU market abuse regulation. Regulators in China and Singapore have also slapped curbs on promotion of cryptocurrency related products and issued guidelines for influencers.
Yes, Akash, I believe that it is high time to regulate these financial influencers. Given that typically the people who are consuming these advice are the first timers, and people who are looking to make quick money based on these advices. It is important that the people who are acting basis that advice are aware about what is the underlying research or underlying content basis what the financial advisor, financial influencer is giving you an advice. Say it is going to be a difficult task even for a SEBI, but given the nature of these transaction having an influence on the market, uh, there need to be ways and means way the technology is evolving. I'm sure even the regulator is trying to catch up to the technologies to find ways and means to regulate these. Like typically, today we have the investment advisor regulation and the research analyst regulation, which would have a little overlap where you could try to fit these financial influencer into the ambit. There can be a not as stringent prerequisite for you to be called as a investment advisor or a research analysis. You can have a little truncated version of those rules and regulation which are applicable to them for the financial influencer as well, so that they can sort of self-register and self-regulate them.
Experts say influencers, despite promoting financial literacy, pose certain risks to consumers as seen in the case of crypto meltdown. The guidelines around influencer marketing are also evolving in various jurisdictions. In India too, influencers have caught the regulators' attention. From the creator's perspective, there could be collaborations with domain financial experts to reduce risks.
The Karnataka High Court recently asked the government to come up with norms to keep a tab on Instagram influencers. Meanwhile, the Supreme Court on Monday upheld the 103rd Amendment to the Constitution, which paved the way for 10% reservation for people of economically weaker sections. A Constitution bench in a 3-2 verdict said that reservation on economic basis does not violate the basic structure of the Constitution. So, what will be the likely impact of this judgment? Here's a report.
Reservation on economic basis does not violate the basic structure of the Constitution, A 5-judge constitution bench led by Chief Justice of India UU Lalit observed this on Monday while nixing a bunch of petitions challenging the 103rd Amendment to the Constitution. The amendment provided a 10% reservation to people of economically weaker sections in central government jobs and educational institutions. But the EWS category excluded those from the SC, ST, and OBC categories. The petitioners, while challenging the amendment, had claimed that the grant of 10% reservation to EWS violated the 50% ceiling cap on quota. They also sought a decision on whether economic backwardness alone could be the sole criterion for granting quota in government jobs and educational institutions for those who were under the general quota. But the judgment wasn't unanimous. CJI Lalit and Justice Ravindra Bhatt dissented with the majority view. The other 3 judges were Justices Dinesh Maheshwari, Bella M. Trivedi, and J.B. Pardiwala. Justice Maheshwari said that reservations were an affirmative action measure not only for socially and economically backward classes but also for any disadvantaged section. Therefore, reservation solely on an economic basis did not violate the Constitution. Second, the exclusion of scheduled castes, scheduled tribes, and other backward classes from EWS reservations was constitutionally valid. Meanwhile, voicing the dissent, Justice Bhatt said the amendment struck at the heart of the Equality Code and was discriminatory and violative of the basic structure of the Constitution. Ashwini Deshpande, a professor of economics at the Ashoka University, said the verdict reinforced the point that this was a quota for the upper castes, even though it was presented as a move away from caste-based quotas. Noting that the income ceiling had not been touched, Deshpande said that any change in it would have opened up a whole new controversy, as India did not have very reliable income figures. The professor believes that the current ceiling is not a good measure of the genuinely poor population, as most Indians fall below this cutoff. According to her, poverty is a transient state and should be addressed through vigorous anti-poverty programs. Shankar Raghuraman, a senior editor with the National Daily, had previously written that if the EWS quota was 10%, the line that separated the poor from the rest should have been determined in such a manner that it covered only the poorest 10% of the population. Instead, a family that was at the EWS quota's income threshold of 8 lakh rupees in gross income annually would actually be within the top 10%. In January, the government had told the Supreme Court that the annual family income of 8 lakh rupees was a reasonable threshold to determine EWS. It said that the income criterion for EWS was more stringent than the one for the OBC creamy layer because, despite being the same cutoff number, their composition was different. On Monday, Justice Bhatt said that allowing a breach of the 50% cap set on reservation could lead to further infractions, which could result in compartmentalization. For their part, the 3 judges who gave the majority verdict noted that the EWS quota did not breach the ceiling limit of 50% placed by the Indira Sawhney judgment on reservations.
It may be that they have restricted what has been said in Indira Sawhney to reservations for the constitutional vertical reservations for SC, ST, and OBC alone. That alone is treated as reservations. This EWS quota may have been treated as apportionment of the unreserved category. Short of that, I don't see how they say that the 50% quota is not breached.
Analyzing the verdict, Supreme Court senior advocate Sanjay Hegde said the case dealt with a complex definitional problem. According to him, following the verdict, there will be great competition among the forward castes to be declared economically backward. Hegde foresees a much more fragmented society following this judgment. He reasons that as they compete with each other, the heartburn that existed among the forward castes towards the reserved categories will now also become visible within the former category itself.
When further questions arise, supposing one set of unreserved candidates wants to challenge another set of unreserved candidates who have got the benefit of EWS and say, no, the fellow actually has 8 lakhs more than 8 lakhs income, his family has more than 8 lakhs income a year, you must include salary which he gets from the government, you must include his agricultural income and all those things. So somewhere or the other, those issues will work their way back to the Supreme Court. And it may well be that at some stage the Supreme Court may be compelled to relook the judgment. But for the moment, for the immediate conceivable future, I do think the judgment will hold and continue to operate. Will it iron out the creases or will it lead to further confusion? I frankly think it would lead to further confusion.
Now that the verdict is out, the government will have to carefully track the second order effects that follow, given how sensitive the topic of reservations is in India and the far reaching social and economic consequences it can have, especially for the most marginalized among us.
Moving on to financial markets. In this earnings season, profits of various public sector banks rose more than expected due to broad-based credit growth. While this does make a case for further re-rating of the sector, data shows PSU banks are trading 25% higher than their historical average. So should you invest in them at current levels? Let's find out.
The PSU bank basket stole the market's thunder on Monday as the sector dazzled amid meager gains elsewhere. The Nifty PSU Bank Index surged over 5% intraday, even as the benchmark Sensex and Nifty 50 indices gyrated between gains and losses. The gains were propelled by Bank of Baroda, Canara Bank and State Bank of India, whose recent Q2 performance has pleasantly surprised many. Consider this. Bank of Baroda's net profit of 3,313 crore rupees beat consensus by 28%. It reported net interest margin expansion of 31 BP quarter-on-quarter, better than expectations. Loans grew 21% year-on-year as against expectation of below 20% growth. Similarly, SBI's Q2 FY23 profit of 13,265 crore rupees, up 74% year-on-year, was ahead of estimates. The outperformance was driven by core earnings led by better than expected net interest margin, loan growth, and low credit cost. NIM expansion of 30 BP quarter-on-quarter after two disappointing quarters was among the highest in the sector. ROA topped 1%, the highest in about a decade. All of this underscores the ongoing bullish story in the banking space, analysts said.
An important takeaway from the Q2 banking results is the significant and in most cases better than expected profitability of the sector. This spurt in profitability is due to the rising credit demand, improving asset quality, and rising margins. A clear positive is that the credit growth is coming from across sectors: corporate, MSMEs, and retail. Since India's growth recovery continues to be strong, this healthy trend in banking is likely to continue in the coming quarters too. The results of PSU bank majors like SBI and Bank of Baroda are more impressive.
Analysts believe Indian PSBs are now better placed with asset quality gradually healing and relatively better balance sheets. According to Motilal Oswal Financial Services, the earnings outlook for PSBs continues to look good, led by an improvement across margins, operating profitability, and credit costs. The SMA pool remains benign, which coupled with limited slippages would aid in sustained or continuous reduction in credit costs. On the bourses, the Nifty PSU Bank Index has outshone the benchmark Nifty 50 index so far this year. The gauge for the state-owned banks has surged nearly 40% so far in 2022, as against 4.4% rise in the Nifty 50 index. The Nifty Private Bank Index, meanwhile, has rallied 17% during the period. Among individual stocks, Indian Bank, Canara Bank, Bank of Baroda, Bank of India, and SBI have leaped in the range of 29 to 76%. So, is it time to ride the turning tide for PSBs, or have investors missed the bus?
The PSU bank stocks are even now under-owned, and there is value in this segment even after the recent run-up in the prices. The valuation gap between private banks and the PSU banks is likely to narrow going forward.
Domestic markets will remain closed today on account of Guru Nanak Jayanti holiday. Globally, investors will eye outcome of the US midterm poll.
Key financial sector regulators like SEBI, RBI, IRDAI, IFSC, and PFRDA recently came together to allow an interoperable regulatory sandbox. It will help them launch hybrid products and services which may need overseeing by more than one regulator. But what exactly is a regulatory sandbox? Our next report has all the details.
Regulatory sandbox refers to live testing of new products or services in a controlled regulatory environment. It acts as a safe space for businesses, as the regulators may or may not permit certain relaxations for the limited purpose of testing. The sandbox allows the regulator, the innovators, the financial service providers, and the customers to conduct field tests to collect evidence on the benefits and risks of new financial innovations while carefully monitoring and containing their risks. Entities are allowed to experiment with fintech solutions in a live environment and on a limited set of real users for a limited time frame. Regulatory sandbox can potentially bring significant benefits. Firstly, regulators obtain first-hand empirical evidence on the benefits and risks of emerging technologies and their implications, enabling them to take a considered view on the regulatory changes or new regulations that may be needed to support useful innovation while containing the attendant risks. Incumbent financial service providers, including banks, also improve their understanding of how new financial technologies might work, which helps them to appropriately integrate such new technologies with their business plans. Innovators and fintech companies can improve their understanding of regulations that govern their offerings and shape their products accordingly. Users of a sandbox can test the product's viability without the need for a larger and more expensive rollout. If the product appears to have the potential to be successful, the product might then be authorized and brought to the broader market more quickly. Finally, fintechs provide solutions that can further financial inclusion in a significant way. Areas that can potentially get a thrust from the sandbox include microfinance, innovative small savings and microinsurance products, remittances, mobile banking, and other digital payments. In India, financial regulators such as the Reserve Bank of India, Securities and Exchange Board of India, Insurance Regulatory and Development Authority, and the International Financial Service Centers Authority run their own sandboxes. The RBI Sandbox scheme, introduced in 2019, is based on thematic cohorts. The first 4 cohorts were on retail payments, cross-border payments, MSME lending, and prevention of financial frauds, respectively. In September, the RBI announced the 5th cohort, and based on the feedback received from various stakeholders, it has kept the theme neutral. Innovative products, services, or technologies cutting across various functions in RBI's regulatory domain would be eligible to apply. The central bank has had a few successful cases under its sandbox initiative. Meanwhile, markets regulator SEBI's regulatory sandbox framework has remained a slow starter. Since 2020, when the framework was introduced, SEBI has received 10 applications for its approval. Of this, 3 have been rejected, 5 withdrawn, 1 under process, and 1 approved.
By the nation's trusted bank, SBI, the banker to every Indian.
India has over 4,200 fintech startups, It is a hotbed for fintech innovations, and regulatory sandbox will play a crucial role in shaping the industry. That's all for today. Catch the next episode of the morning show tomorrow. Bye-bye for now.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.